Let's look at a sample fund investment model. And this is, remember, this is very different from the typical corporate equity research models or fundamental research models that quite a lot of us are used to. So this is an investment model for the fund and a cash flow statement for the fund. So we have to look into perspective of what would come inside the fund in form of cash and what would go outside the fund. And remember, this is very important to predict the liquidity for the fund on a year-on-year basis. So let's talk about the outflows of the fund. So one big outflow for the fund is investments that they would be making. So let's take an example here. So let's assume that this is a structured credit fund. So therefore, it would invest in the non-listed instruments of entities on a credit basis. There can be multiple agreements. For example, there could be an equity upside, etc. on the deals. But typically, these would be credit investments drawing in, a certain level of interest rates from the deals that happen. So the first outflow is the investments, and it's a big outflow because the fund would be making investments into the investee companies. And typically these investments outflow will happen more in the year 0, year 1, year 2, because the deals will generally be of a 3 to 4 year duration. And therefore the fund will stop investing by year 2 or year 3. So you would not see any major investments happening post the year 3 year. Then there would be setup cost for the fund. So whenever a fund is set up, there is an initial setup cost that is incurred. The setup costs include appointment of trustee, custodians, legal fees, etc., etc. So all of that would come here, or maybe some bit of it here. Then there would be management fees. So remember, we spoke about the investment management agreement between the fund and the investment manager. So investment manager has to be paid and management fees, and therefore all of this would come in all these years. Further, there would be expenses of the fund. So remember, apart from the setup cost, there are other expenses which they incur on a regular basis. For example, trusteeship fees, they pay on a regular basis, the office administration, etc. So all of these things will again go all across. Now, when the fund has made investments, of course, it will start reaping the cash inflows from the investment, since it is a structured credit fund. So the fund will have to make certain distributions to the investors, and that distributions is generally mentioned in the preliminary agreement that is being entered into, and typically starts from year 2 or year 3 in the form of certain semi-annual or annual cash flows, and a certain bips or certain interest rate is mentioned, and it all starts from year 2 onwards. And then subsequently, if the firm has made investments until year 3, therefore any investment that they made in, let's say, year 1 here will kind of mature in year 4 or year 5 here, and therefore as the investments mature, and let's assume that the fund duration is 6 years, so they will have start paying the investors return of capital from year 4 or year 5 onwards. And then there is carry. So these are the total outflows of the fund in terms of this entire example. So now let's look at the inflow side of the fund. So we will have capital drawdowns. They are not typically done all at one go. So we will have some drawdowns in year 0, 1, and 2. Then we have income received on each of these portfolios. Now remember that these portfolios are just 2 sub-portfolios for the overall fund. So this will typically have the interest income from the investments, or a regular recurring income which comes in all the years until the investments mature. Principal maturing would be feeded roughly from third or fourth year onwards, because average duration of the investments would be somewhere around 3 to 4 years. And then we have redemption premium received. Redemption premium received is particularly when the deals are entered in such a way that at the end of the period when the investments mature, they typically have premium clauses. So they yield a certain premium at the time when they are redeemed, and therefore this is also an inflow for both the portfolios. So if you look at the income side of the picture, it is primarily the capital drawdowns and the income received from the investments, whether it is in the form of regular interest income or is in the form of principal maturities or redemption premiums. Now, it's important to note that this fund investment model is a very very critical part for the managing the cash flows of the fund, and therefore the fund manager has to plan things in such a way that he is able to maintain sufficient liquidity at the end of each year and make sure that the investments mature in a staggered way. This is for now. I hope you liked the overall schema of the fund investment model. And therefore, next time when you read a fund investments report, you would be in a much easier position to understand the flow